expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you, and you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are no operators standing by. I am it.
Quiet, numbskulls. I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference, 800-306-1990, 800-306-1990. 1990. Yes, of course, we celebrate every day on Ron Siegel Radio. Holy cow, we're getting ready right just about at the Thanksgiving holiday. But before we get there, National Play Day with Dad. I like that one. I'll put a little applause meter on that one. Blase Day, Shopping Reminder Day. Does anybody need to be reminded to go shopping? And having beaten anorexia, we'll go with National Parfait Day. National Parfait Day. We like that one. That sounds a little bit enticing. Let's take a look and see what the markets are doing this morning. They've been on their steady upward rise. Looking at the Dow Jones Industrial Average, up 116 points as we speak today. S&P 500 up 18 points. That's been on a consistent upward rise as well. The NASDAQ, that one, holy cow, NASDAQ up 101 points. That's a huge rise for the NASDAQ, double the S&P 500 or the Dow. So that one's a big winner today. Oil's down 15 cents a barrel, but I generally try to really taper on what's going on in the oil market just because you and I both know, living in Calizuela, oil prices, well, they just go on one direction because we've got a state government that really enjoys high oil prices. They like to continually stiff us. So they've gone away because we've caught on to the fact of them telling us what the taxes are on oil in Calizuela. So when we get away from the taxes, now they decide, well, we're not going to call that $1.07. We're at 61.2 cents a gallon in taxes. Number one in the nation, highest tax rate in the nation, right here in Calizuela. But they don't tell us about the $1.07 in fees. Yeah, that's the cap and trade fees that Governor Newsom wants. So we're looking at $1.68 a gallon just in state and local taxes and fees. Unbelievable. I don't get it. Yeah, no one's happy about that. $2.59 is the national average for a gallon of gasoline. Here in Calizuela, we are at $3.86 and a half. Still about 30 cents, 20 cents a gallon more than Hawaii. Or if you want to compare us to Louisiana, $2.21.7. Yeah, so we're paying the price for the elections. The elections have consequences. If you voted for the party that is controlling everything in Calizuela, well, you can say thank you. You have got the taxes that you voted for. You have got the whatever you voted for. So you get what you vote for. If you want to keep it up, keep it up. If you don't like it, sorry. Those of you that are involved in Uber, like to ride the Uber, well, if you're going to London, sorry, Uber has been stripped of its London license. As a regulator says, it puts passengers at risk. Transport for the London site, a pattern of failures from Uber that placed passenger safety and security at risk. TfL had first suspended Uber's license in 2017. Uber says the decision not to renew its license is extraordinary and wrong and will be appealed. Not doing a lot of wonders for their stock prices, moving right along. Wall Street forecasters, they're looking at just a 5% gain for 2020. Wall Street equity strategists see stocks posting far more modest gains next year compared to 2019, with the average S&P 500 target of 3272, implying a little more than 5% next year. We're up, I think the number last I saw was about 22% so far this year. We'll see how the year ends up. If you're up that much this year, does it really surprise anybody that we might not be up as much next year?
Surprise, surprise, surprise.
Yeah, it's not going to be a whole big surprise when you see that prices are not going up quite as much. Big firms, they're moderating on their spending on equipment and other capital investments as uncertain business environment prompts some to postpone or shelve otherwise promising projects that could pose a continuing drag on economic growth. The pullback began as trade tensions escalated last fall, leaving companies unsure about their supply chains, pricing, and profits. Just remember, that's coming from the Wall Street Journal. They've got their vested interest in how they want the markets to be portrayed. So just remember, we got to always look at who's saying what whenever we're getting this information. Who is saying it? Who has benefits from what's being said? Just throw that out there for you. Keep an eye on it all the time. You got to really just know who's telling you, because we don't have anywhere that I know of. Well, there's only a couple places I do go to get unbiased news coverage. And when I talk about news coverage, I am not talking about people that are giving me strictly their opinions, because I just don't need their opinions. I can formulate my own opinion. I want some place that I can go to get plain old-fashioned news. I want to tell me what's going on in the marketplace. Let me form my own opinion. I just need someone to go and do some of that research for me. Got a couple sources. I share a lot of that data with you right here on Ron Siegel Radio on a regular basis. So make sure you check in here all the time on a Monday through Friday, 9 to 10 a.m. If you miss a broadcast, Ron Siegel 1, Ron Siegel the numeral 1 on YouTube. We put all the information that we think is great for you right there on our channels so that you can get that information regularly. That's just a tool that we offer to all of our listeners. We'd like you to be well-informed, know exactly what's going on a regular basis. We go and search all over. We get broadcasting or prepping for the radio shows every single day. Every day that we're on air, we're getting ready for radio by about 4 a.m. here in Southern California to find out what we can share with you that makes sense, that is something that we feel is going to either move the market, have an impact on you, or keep you updated on what's happening in the world. So we just give that to you each morning. Throw our opinion in there, give you the news, give you our opinion. You can formulate your own opinion. McDonald's, it looks like McDonald's is in the news also, paying $26 million to settle a wage suit that went against them. See what happens there. That will follow that story for you also. It's all in California. McDonald's paying $26 million. Corporation agreed to pay to settle a nearly 7-year-old lawsuit accusing the fast food chain of underpaying U.S. staff at its corporate-owned restaurants in California. Don't know how many of them are corporate-owned. Most of them here in Southern California, I think, are franchises. I don't know that there's a lot of them that are corporate-owned. But McDonald's in the news, not in a method that you really want to see them. Goldman Sachs coming out with their report. A lot of times these companies, they do not want to have a unified government. They don't like it when we're in times like we are here in California, where one party controls everything. So Stock Market 2020, Goldman presents a gloomy unified government scenario with the end of the year and the decade fast approaching. Wall Street strategists have begun to deliver their expectations about where the stock market will close out next year, not this year. The next year will bring with it myriad of market-moving events, including the 2020 presidential election and next phases in U.S.-China trade relations. Market pundits across Wall Street have each delivered their ideas for how these and other catalysts will shape equity markets in 2020. Stocks have flirted with fresh record highs time and again in the fourth quarter of 2019 as global growth concerns receded from a fever pitch earlier this year. As mid-November, the S&P 500 was up more than 23% for the year to date. I just told you that a little bit earlier. Unified government after the 2020 elections represents a downside risk to stocks, according to Goldman Sachs. I guess they're of the belief, high likelihood the president will be reelected. And the impeachment movement will probably turn the House of Representatives back over to the Republicans, giving a unified government. The only way it's going to be unified is obviously if the president, Senate, and House are all the same party. In a revised equity outlook, Goldman Sachs strategist David Kostin lowered his earnings per share view for the S&P 500 companies to $174 from the $177 seen previously, while he maintained his previous base case target for the blue chip index to hit 3,400 in 2020. He noted that political factors could prevent stocks from appreciating to that level. Well, we'll keep on watching it for you. We'll see what happens there. And you are listening to Ron Siegel Radio, discussing your real estate, current events, and the finance. Oh, holy cow, where'd that one come from? Current events, financial markets. You throw me all off on my whole conversation there. So you're listening to Ron Siegel, discussing your real estate, current events, financial markets. When we come back, 7 reasons to list your house this holiday season. How long can the economic recovery last? The cost of real estate across time. All that and more. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Connect with us, Facebook.com/Ron Siegel Radio. On Twitter, @Ron Siegel. And if you miss any part of our broadcast, shame on you. The replay is available, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Are you earning a safe, secure 10+% return on your investments? Is your credit score over 800? Are you living in the home of your dreams or simply where you think you can afford? If the answer to any of these questions is no, what are you doing about it?
need some trusted guidance, that is my message, and I will be delivering it every day. Very focused show. I guess that's not really the right rejoiner, I guess. My gosh, I got the Monday morning. I guess it's a tough time. You just need some trusted guidance is the message. That's my message. I will be delivering it every day as your consumer advocate. You can reach me again, 800-306-1990, 800-306-1990. Good morning, Sergio. Glad to see you with us today. Good morning, Cheryl, Cindy. All glad you're all with us this morning. Happy Thanksgiving as we get ready for the fun festivities going forward. The Mortgage Minute today brought to you by our friends at Gold Star Mortgage. When you're ready for that next mortgage, Gold Star has the programs and the products. You just need to give me a call at 800-306-1990. Dow Jones Industrial Average up 122 points. S&P 500 up 18. NASDAQ up 98.75 right now. The 10-year Treasury dropping down a little bit on the yield to 1.757. And the mortgage-backed securities up just a little bit, up 3 basis points, which means interest rates are down ever so slightly, not enough to even matter. So we're not going to even talk about that part. But what is driving this market today? That is the issue that has really more importance than any of the other parts. Well, the bonds, they're trying. Yeah, Sergio, I think it might be 5 o'clock. Yeah, I think my mind thinks it's 5 o'clock. Stocks are moving higher on more optimism of a trade deal between the U.S. and China over the weekend. China said it will raise penalties for those violating intellectual property rights. That's good news. Additionally, U.S. National Security Advisor Robert O'Brien said on Saturday that a Phase 1 trade deal could happen before the end of the year. As a result, stocks across the globe are rallying higher. Mortgage bonds are trading near unchanged levels ahead of an action-packed week. Holiday shortened week with the stock and bond markets closed all day Thursday and on a shortened schedule on Friday. As a result, many of the reports have been crammed into the next 2 days. Tomorrow, it's all housing data. The Case-Shiller, the FHFA appreciation reports will be released, as well as new home sales on Wednesday, durable goods, third quarter GDP, initial jobless claims, personal consumption expenditures. That's the Fed's favorite measure of inflation. Pending home sales will be reported the rest of the week. Tuesday, again, Case-Shiller, FHFA, new home sales. Wednesday's mortgage applications, durable goods, GDP, initial jobless claims, personal consumption, pending home sales. Nothing on Friday, nothing on Saturday. Whew. There's a lot going on in the marketplace. So we're going to continue watching all of those for you. Now, I did share our chart of the day that we've been going with, that we've been showing this morning, has been a chart showing what some of the different companies in the marketplace are anticipating for home price appreciation going forward. And I've got that shared on the screen right now. 2019. Now, I love the home price expectation survey. Why do I like the home price expectation survey so much? Well, the reason is they take 100 industry professionals, economists, bankers, economists for the most institutional, that'd be like the Zillow, the NAR, the CAR, also educational economists, and put them all together and tell us what they're projecting, what they're forecasting. Well, 2019, the projection's 3.6%, 2020, 2.5%, 2021, 2.2%, and 2022, 2.7% appreciation. Notice I did not say that we're looking at prices going down in any way from any of those individuals. So that's the big issue right there. I keep hearing it over and over again, recession in 2020. And I agree, there will be a recession in 2020. But a recession does not mean that property prices are going to go down. Here's the chart on that one for you as well. Last 5 recessions. What does property values do? 1980, 6.1% up. 1981, 3.5% up. 1991, down just a little bit, down 1.9%. And the 2001 recession up 6.6%. Now, Why does everybody worry about these recessions? Well, we all lived through 2008 when property values dropped dramatically. So we say, well, if that's what happened in 2008, that's probably going to be what's going to happen again. Well, 1 out of 5 times did we see any kind of a significant drop. 1 out of 5. If it's 1 out of 5, I'm going to say that maybe there's more likelihood is that the other ones are going to be more realistic. I mean, if you look at the other 4, I'm guessing, and I didn't do the math here to see what it is, but 12, 18. So we're looking at about a 6% gain out of those other 18 divided by 4. So we're probably looking at 4% gain, a little over 4% out of the last 4 recessions. So you've got one anomaly. Is the anomaly the one that's going to be the one that we have to watch for everything? Or do we just say, well, you know something? That's what happened then. It probably won't happen again. My suggestion or submission to you is the 1 out of 5. That's happened 20%. Now, yes, we did see that happen in the 1920s. There were not many of us around in the 1920s. So we did see property values take a big drop during the Great Depression. But for the most part, that's not the norm. That's not where we see most things happening. So let's not look at that and say, well, that's the where it's really going to be, right? That's not exactly what the common place is. So let's just take a look at it and say, you know something? A lot of these other economists who do study this on a regular basis, they probably have a good handle. They look at what's going on in all of the different areas. They look and say, why is it the property values would go up in a recession? Well, let's understand what we're talking about here. You end up, a recession generally is going to start, obviously we know the definition, two consecutive quarters of negative GDP. Okay, so we understand that part of it. But generally, we also see that unemployment increases in a recession. We're at near all-time lows right now of unemployment. So we can anticipate that unemployment will go up. So if unemployment goes up, say 1% of our 300 million Americans, 3 million Americans losing their jobs, but that means 327 million Americans are going to have benefits here. What's the benefit? Well, property values are going up. We understand that. If they sell their house, they get more money for it. But we also see frequently that interest rates decline in a recession. Interest rates decline in a recession. So what tends to happen is we see that mortgage home affordability becomes more affordable. So when you look at the chart I'm sharing right now, you look at it and you say, okay, well, the higher the number, the less affordable property is. We're looking right here, home affordability is very, very low historically. As it goes lower, when you start looking what goes into home affordability, well, wages are going up. We're not seeing a wage decline. We're seeing property values go up. That's not going to be good for home affordability. But interest rates going down is a benefit for home affordability. So overall, we're looking at home affordability improving in a recession. What that means is more people are out there buying homes. When more people are out there buying homes, that means the demand goes up. Supply is fairly consistent. When you've got demand going up, prices are going up. That's why we've seen over the last several recessions, 4 out of the last 5, other than the one that was pretty flat, property values continue their normal course upward. When I say normal course on a historic basis, we're generally looking at a 3% appreciation rate annually nationally. And you look at it and okay, so we look over those 4 recessions, other than the anomaly, we know that we've got the one outlier there, are up about 4% during the recessions on average. So let's not get too excited over property values when we understand the real facts behind these. A lot of people have their opinions. These are just the facts that we have for you. And you are listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, 7 reasons to list your house this holiday season, the cost of real estate across time, how long can this economic recovery last? All that and more. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Connect with us, facebook.com/Ron Siegel Radio, on Twitter @Ron Siegel. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Siegel Lending Team offers you buying power. Let's say you can afford a monthly mortgage payment, including principal and interest, of around $1,900. With today's rate on a 30-year fixed mortgage of 3.75%, APR 3.85%, that payment could support a $416,000 mortgage. But if you wait and rates tick up to around 6.5%, which is roughly the average home mortgage rate over the past 30 years, that same $1,900 mortgage payment, including principal and interest, may only be able to support a $314,000 mortgage. That's over $100,000 worth of home you're missing out on by waiting. That's buying power. All you need to do to get started is reach out to the Siegel Lending Team at 800-306-1990. That's 800-306-1990. Or visit SiegelLendingTeam.com. That's SIEGEL LendingTeam.com. Payment example excludes taxes and insurance. Call us for full details. 800-306-1990. That's 800-306-1990 or SiegelLendingTeam.com. Equal housing lender. Licensed under NMLS number 217037.
Are you purchasing or own a luxury home? If you're like so many others, your home is your largest asset and the mortgage is your largest debt. The Siegel Lending Team has some amazing financing opportunities right now. Jumbo loans up to $2 million, 30-year rates below 4%, 15-year rates near 3.5%, and if you can believe it, 7-year interest-only hybrids in low 3s. The Siegel Lending Team has all the options for your jumbo or second home loan requirements. Take advantage of them while you can. To learn more about all the other financing products available from the Siegel Lending Team, call 1-800-306-1990. That's 1-800-306-1990. Or visit SiegelLendingTeam.com. That's SIEGEL LendingTeam.com. Again, call 1-800-306-1990. Rates subject to change without notice. Licensed by NMLS ID 217037 and 14550.
Text NEST, N-E-S-T, to 79564. Find your dream home before someone else does. If you already have your dream home, text SLT Home Digest, SLT Home Digest to 79564. We will share with you. It's a monthly report that comes out to you, tells you precisely what the county recorder believes about your property, or what they know, what they've got listed on your property. It'll tell you what the marketplace believes about your property. Does it on a monthly basis, gives you all that information totally free from your friends at Ron Siegel Radio. So let's take a look and see 7 reasons to list your house this holiday season. Around this time each year, many homeowners decide to wait until after the holidays to list their home. Similarly, others who already have their homes on the market remove their listings until the spring. Let's easy for me to say, unpack The top reasons why listing your house now or keeping it on the market this winter may be the best choice you can make. Here are 7 great reasons not to wait. Number 1, relocation buyers are out there now. Many companies are still hiring throughout the holidays, and they need their employees to start as soon as possible. Number 2, purchasers who are looking for homes during the holidays are serious buyers and are ready to buy now. You can restrict the showings on your home to days and times that are most convenient for you. You will remain in control. Number 4, homes show better when decorated for the holidays. Number 5, there is minimal competition as for you as a seller right now. Over the past few months, we've seen the supply of homes for sale decreasing year over year, as shown in the graph that I shared earlier on our social media channels. I'm going to try and get this graph ready for you during the break. I'll see if I can get this up and posted to share this graph with you, because it does show the housing supply year over year, and it kind of gives you an idea throughout the year for the last 12 months. So we like to show that and give you an idea. Okay, and this is according to the National Association of Realtors. November, 4.2% housing supply year over year up. We've gone all the way down to October, down 4.3%. Number 6 in the list, the desire to own a home does not stop during the holidays. Buyers who are unable to find their dream homes during the busy spring and summer months are still searching, and your home may be the answer. Number 7, late fall and early winter makes up the sweet spot for sellers. The supply of listings increases substantially after the holidays. Also, in many parts of the country, new construction will continue to surge and reach new heights in 2020, which will lessen the demand for your house next year. Bottom line, it may make the most sense to list your home this holiday season. Let's chat about it, see what works for you. It's all about what makes sense within your family. That's the idea. When are you ready to make the changes? When do you need to make the changes? If you're thinking about selling, do you want to maximize that profitability? That's what we're talking about. When you talk about selling, it's all about maximizing the profitability, maximizing your return. How do you maximize the return? Well, that comes from getting your property out there when there's the least possible amount of competition. That's why I talked to you about selling during the holiday period. Yeah, we know that it's not the most pleasant selling in the holidays. That no one really is out there saying, hey, you know something, I want to sell during this time period. But it's not about what's being pleasant when you're dealing with one of your largest assets, maybe even the largest asset you and your family have. So if that's the case, aren't you really just looking to maximize the amount of money you can get from that asset being your home? Well, if you're doing that, the idea here then becomes, let's say there's, just for round numbers, say there's 100 houses in the market on the spring. Well, when you go and look and say in November, December, that number is going to drop significantly. Maybe there's 30 or 40 houses this time of year. Well, that means there's more demand, but the supply is still there. So that's the reason we say all the time, hey, take a look at this. See if it makes sense for you and your family. If you're thinking about selling in the spring, if you can do it now, right? If it's not going to hurt what your family goals are, do it at this time of year. Here's that chart I was telling you about. Our crack team got that for you. The housing supply year over year. And you can see housing supply right now is down 4%. That when you hear numbers that come out and they start telling you, well, the sales are down in housing. Well, why would sales be down? The answer to why sales being down is very, very simple. Sales are down because, look, when supply is down by 4 and almost 5%, doesn't it stand to reason if you have 100 houses on the market, now there's only 95 houses on the market, sales have to be down because people are not going to find the property that suits their family needs, their family goals. That's why that happens. So we like to share with you the whole story. Sometimes the media just doesn't give you the whole truth. They might give you part of the truth. And I'm not saying it's fake news, but I'm just saying that they're not always giving you all the numbers. That is the Real-Time Real Estate segment, again, brought to you by the area trusted real estate professionals of Ron Siegel Radio. Text NEST, N-E-S-T, to 79564. Going to go to break just a little bit early here because I want to get another chart up here for you showing you the cost across time and mortgage rates over time when you're waiting, because I keep hearing people saying that there might be a reason to wait for what's coming down in the future. And I'm going to say to you, I don't know that there's a good reason to wait to buy a house to see if property values drop, because the biggest issue that we need to watch out for on all the time is the price of a property is really important. But what's even more important than price on property is interest rates. The interest rate is going to have a bigger impact on your property than anything else. And I shared this chart. In fact, I'll do it right now. We won't even go to break early. I'm going to share this chart with you because I did share this on our social media channels over the weekend, probably last Friday, on what interest rates look like. And I'm going to And right now, obviously, we've got interest rates extremely low. I'm going to look and see. Let me get that chart right here. And I'll tell you, as of Friday, Freddie Mac's interest rate, this is their baseline, so not everybody qualifies for this number, 3.66%. A year ago, it was 4.81%. So we're 2/3 of where we were at the first part of the decade. And if you look, we're probably close to 1/3 of where we were in the 80s when your parents probably bought their first houses. So understand what these things mean to you and how they affect your purchasing power, because that's the big issue, is the purchasing power that comes from this. So interest rates now about 3.66% of the at 6.66. Great time to look back at where they've been over the past decades. I'm showing you that on our screen right now. According to Freddie Mac, rates are projected to increase to 3.9 by the time next year. The impact of your interest rate has on the monthly mortgage payment significant. An increase of just $20 in your monthly payment can add up to $240 a year, $7,200 over the life alone. Maybe it is time to lock in now while rates are still historically low. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, how long can the economic recovery last? Buyers, they're out there looking for your house right now, so we'll talk about that one as well. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Connect with us, facebook.com/Ron Siegel Radio, on Twitter, @Ron Siegel. And if you miss any part of our broadcast, shame on you. Replays available, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
change and without notice. Licensed by the California DOC and BRE NMLS 217037 and 145502 and Cal BRE 0186945 and 1866775.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. In the Your Credit Matters segment today, being brought to you by creditsanitizer.com, you have a credit report. It is wrong. What are you doing about it? Credit Sanitizer has these solutions for you. You just need to make that phone call. When an original creditor and a collection agency show up on your credit report, not a surprise. It's discouraging enough when you can't pay a debt and you know that it's going to damage your credit scores for years to come. But what about when a single debt multiplies, turning into 2, 3, or even more negative items on your credit reports? A discouraging situation can turn downright miserable. Find out why there may be an original creditor and collection agency on your credit report, and if there's anything you can do about these situations. Can a collection agency report an old debt as new? Unfortunately, a collection agency can often report old debt as new. I see these double jeopardy trade lines all the time. Let's say you fall behind on an account, your creditor charges off your account, your credit report will show the list of a charge-off, which is very negative to your score. Then the creditor sells the debt to a collection agency, which also reports the debt as a collection account. Now you have 2 negative accounts. Both the original creditor and the collection agency will be listed on your credit reports. That's kind of like double jeopardy right there. Not a fun thing. That's double the damage and is not permitted, says many folks understanding these laws. How can you multiply accounts impact your credit? Well, the original creditor can't continue to report a balance due if it has sold the account to a collections agency. However, it can report a charge-off, which remains on your credit report for 7 years, even if you pay off the debt with the original creditor or via a collections agency. But the debt may continue to impact your credit for longer than those 7 years because the collections company can also place an item on your credit report depending upon how the account is handled, whether it's within the statute of limitations or whether you attempt to negotiate or pay the debt. The item can appear on your credit report for as long as around 7.5 years from the last payment activity. So if you make a $1 payment, that is going to restart the clock. So be careful there. How often do collection agencies report to credit bureaus? Collection agencies can report to all 3 of the credit bureaus almost as soon as they purchase the debt. They can then report monthly on the status of the debt for 7 years and 180 days from the date they took the account. Luckily, you're not left without options if you find yourself in this double jeopardy debt situation. First, consider ordering your credit report so you understand the situation. What information is showing up there? You can request your credit score for free annually from each of the credit bureaus. I love myfico.com. That's where I get mine. That's how I watch my report. If you know the debt is valid, you may be able to negotiate a settlement payment with the original creditor. If they've already written off the debt, they may accept a lower payment total. This is especially true if fees and interest have inflated what you originally owed. If you satisfy the original debt, you can request that the collection agency stop contacting you. You may also be able to request that the collection agency item be removed from your credit report, although the charge-off will remain. Collection agencies often buy debt for less than the original owed, so you may be able to negotiate a lower payment with a collection agency if necessary. If you can prove that the reporting isn't in line with the Fair Debt Collection Practices Act, collection agency may remove it. However, it can be difficult to get a collector to back down, and you may want to bring in assistance, such as an attorney who works with credit repair. We've got a few of them that work with Ron Siegel Radio, so we can be very, very helpful in that area. So here are some actions you can take to address and dispute duplicate items on your credit report. Number 1, require validation of the debts. Under the Fair Debt Collection Practices Act, debt collectors must send you a written notice of the debt within 5 days of initial contact with you. After that, you have 30 days to request verification of the debt. If you request verification of the debt, The collection agency should provide enough information to establish that the debt is legitimate and accurate. Send validation letters via certified mail or other confirmation delivery method to each of your debt collectors. Ask them to identify the original creditor, current owner of the account, current balance, and date of last payment. Second, dispute collection accounts that do not appear accurate. Send dispute letters again by delivery confirmation to any of the debt collectors. Do not push that button that says dispute on a credit report if you go online. Do not do it that way. Your letter does not have to be fancy or detailed, but it must state that you dispute the debt. This dispute then requires the debt collector to list the account as disputed on the credit report. This notation reduces the harmful effect of the trade line on your credit score. If the debt collector fails to mark the account as disputed, you have a cause of action under the Fair Debt Collection Practices Act. Number 3, get help with credit repair. Once you determine that something isn't quite right on your report, considering getting professional assistance in disputing issues and repairing your credit. CreditSanitizer.com, our friend Jeff Sipes and the Blue Water Credit team, they understand this. How to deal with double jeopardy trade lines. If an original creditor and collection agency appear on your credit report, don't fret. You still have options. Request validation of the debt. Work with a credit repair company if necessary to remove inaccurate items and pay off the debt as quickly as possible to avoid incurring more debt. Now, here's the issue. When you go and pay off the debt, in many, many instances, you can get the debt collector to take that off. You can negotiate with them to take that off your credit report. When you negotiate that with them, you ask them, hey, I'll pay you whatever you percentage you agree to, but you must remove this from my credit report. Sometimes they will, sometimes they will not. But when they don't, then you can go back and dispute it again. If it's and many times they're not going to reply to the dispute because anything that is disputed must be verified by the bureaus. When they go to verify it, do you think the collection company wants anything to do with your debt once they've collected whatever they agree to? Now, they don't have to take it off, but in many instances, they're going to take it off because they don't want to go through the work, or they're not going to take it off. They're just not going to respond. When they don't respond, you win. So make sure once you've paid something off, make sure you go back and dispute it just for the benefit of getting rid of it, getting it off of your credit report. Just a thought there for you. Crazy day. I appreciate you listening to us on Ron Siegel Radio, and I ask, set that first radio preset button to come back here every day to join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to John, who's engineering us today. And, of course, a thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We will talk to you next time on Ron Siegel Radio.
Lights go out and I can be saved. Tides that I tried to swim against put me down.